But endorsing. I can use it. Where do you go? I'm going to try to go.
I'm one of the instructors for corporate finance and at Georgia. And today we are very happy to introduce Danilo Santiago. And so Danilo is a Columbia Business School grad in 2001, right? So that's great. And after he has done his MBA here, he went back to McKinsey, right? And then to hedge fund, he has been developing this valuation method and have been investing for more than a decade, right? So today we are really happy to have Danilo here and to show you how those valuation methods we learned for the past 4 months, really work in real world, right? So I try to convince you, right? This is really important. I mean, I have been, repeating for so many times. So I think it's better to have someone who have actually used that for trading, for investing, to show you how this thing gonna work. Now, without further ado, let's welcome Danilo to show this. Thank you so much.
So, what I would like to do today, and I have many classes here too. Tier 1 was new at the time. Yeah, like 15 years ago. What I would like to do here is walk you through what I have learned over the years. Literally what I do today is investing in US equities. And my approach is very fundamentals based, very models driven in terms of translating fundamentals in figures, in EPS numbers. And the tool that you use to do that is corporate finance. Right, so you are on corporate finance 101. This is 15 years later, right? What you can really do. So what I would like to do today is first establish that link between what you're learning and the real life application. The problem with when you're starting to learn corporate finance, it always looks like that you can make those models speed evaluation of whatever you want. right? And that's the typical critique that you're going to see. It's like, look, if I change my growth rate in the perpetuity part of my model, this is worth 3 times more. But what you're going to see here, that when your template is fully developed and you really have a lot of checks in terms of what is the implied return on invested capital that I'm getting when I make those assumptions? What is the growth rate or market share rate? When you start to really lock your analysis with a lot of constraints, you see that's not that easy to make evaluation spit out any number that you want, right? So I'm going to show you this. The second thing that I want is, you're all students, this is after all a corporate finance class, to provide you some ideas of fundamental analysis that you can use in your own corporate finance class and, quite frankly, for the future. Many of you will work with finance analysis. You're going to be the MBA guy in the room, that even if you're not working with the financial side of the business, you will be present in many of those presentations. So I hope that you, in those years here, you learn how to do this, or at least start at it, because it will serve you well in the future. Now, how am I going to do this? A couple of things. First, I'm going to explain why fundamental analysis work as investing. Again, I am an equities investor, so I'm bringing here one example of how you can use this. But you can use this to do M&A, you can use this to do a private equity deal, probably not venture capital, that's a different kind of objective. But for a series of other deals, or where you need to extract the value of a company, that is a very useful tool to have. But I will explain to you to give you some context before I do what I'm going to do here, which is show one of my analyses. It's extremely overwhelming for those that are starting this. By no means is no one is expecting you to invest that much time to build templates or models similar to those. But you're going to see, I'm going to zoom in very specific points in that template, and you're going to see that the concepts of corporate finance are there. And you're going to see the link with the fundamentals. The EPS number that you see from a company always come from fundamentals, that if you had a crystal ball, you would be the richest person on earth. Because fundamentals is what eventually drives the price of assets. Right? Investors are usually wrong at any given moment, but in the long run, they're really trying to apply a certain value in a future cash flow, if you will, that makes some sense. So let me go then, and we are going to have some time for Q&A at the end. So let me start with this here, which is, again, this is now from my perspective of an investment manager of US equities, right? So corporate finance, valuations can be used for a broad set of things, but for an investor, that's what you want to do here. Blue line is share price. If you have, or what you would like to have is a fair price for that security that evolves over time. Here is, it's only a line here. It's just you're going to see a real one. And what you would like to do is, as an investor, is the quintessential, buy at point number 1, close short at point number 1, close your short at point number 2, buy at point number 3. Close at point number 4, short at 5, close at 6. Those were actually actual trades that I had in a hedge fund. If I were that good to do always like this, again, I would be the richest person, not Warren Buffett, right? Not, it doesn't work like this every time. But the idea is to do that. To have true corporate finance valuation. Let me see if I can have a pointer showing up there. There we go. So what you want to have is have some methodology that will give you that line over time that you can use to place your positions. Now, the reason why you will be able to use fundamentals is to make investments is, first, you have two conditions that are present in the market, which is condition number one, there's a short-term bias. In other words, what makes the market change their opinion from valuing a security from $5 to 25? Yes, those are many years in between those years, but it's so massive, right? The delta in valuation is massive, so there must be something causing prices to move that way. Second is though, are they really moving randomly, or they are coming back and reversing to something? And they are reversing to what I'm going to show you, that you can try to have a grasp what is that number that it will reverse to through valuations, corporate finance, which is, let's say, this black line here. So in other words, it looks like for some companies in some countries, it doesn't work for every single company in every single country, it looks like there's something biasing this share price as if you were pulling in a rubber band, right, or pushing that, whatever. So meaning it tends to go to that average back, but with short-term deviations. And so let's go to condition number one, because that's very easy to see. So let me take a couple of minutes to explain what this chart is. Of course, you have here share price in pink or blue. The blue is adjusted for dividends. So in other words, if you buy something for $35, but the company pays a lot of dividends, from the perspective of today, it looks like that you bought it cheaper, right? Because you got all the dividends. So that's the difference between those two lines. That's simple. What you also have are those red dots here. Those are actual earnings per share. That you go to Yahoo Finance, Google Finance, whatever, that's the number that you see. And then what you have here in blue, that is that little line here is actually going back 2 years. For each one of those red dots, you see a line going back, and it goes back 2 years. And that's the average sell-side analyst estimate. This is all downloadable from this I use FactSet, by far the best system that's out there for fundamental analysis. But you can, build your spreadsheets to show you stuff like this. And what can you see here? It's obvious that there is a correlation between actual earnings and share price, right? And more than actual earnings. Sometimes you see here, these earnings here that end up being around, sub $4, it started being forecasted as almost 6. So when earnings didn't materialize as the sell side was forecasting, prices really came from $100 to here, basically 50. That's a 50% decline. Again, in a few months, that's the same company. Nothing really that important happened in between those dates. I'm going to show you. It was just expectations that if you guys had a chance to look at the material of the presentation of the company, that's this frac sand segment that the sell-side analysts were out of control during those, let's say, couple of years, right? And you see, again, the market going from 50 to 100 and back to 50 based on expectations in a new segment that had $20 million in sales, losses, but yet that moved the share price of the whole corporation. So that's the condition number one that I was mentioning. And you can observe, you can plot it, it's there. It's public information, right? The second condition, I'm going to do this very fast because I don't want to see if I can do this. Yeah. So this, what it is, I'm going to show you later that you can calculate an internal rate of return at any given moment for a company. Let's suppose that you have a crystal ball, that you have all the future cash flows, right? And this, again, this is the concept of corporate finance. If Warren Buffett goes and buys a company, the whole company, what does he get in the future? Just the cash flow, right? There's no market to bail him out. There's no negotiations. He gets the cash flow. So when you buy a company, cash flow out, a bunch of cash flows in perpetuity, if you will, from that asset. If you plug this on Excel, it's going to give you the internal rate of return, right? Very simple. You guys probably have done a lot of these already. So what I have done for a group of 60 companies that I follow continuously. Some of them, my first valuation model was 12, 13 years ago. Is for each one of those, I calculated that internal rate of return for the past 20 years. 20 years ago, I got the price it was being traded. 20 years ago, I have 20 years of actual data plus my forecast. If I move my forecast, the very old dots or calculations do not move. More, closer to today, they will move more. In other words, let me show you one case here, which is, that is again, Eagle Materials. Let's suppose that you had bought this company here in 98, 97. You have paid whatever it is here, let's say, $7. And all the cash flow that really happened here over the next 20 years was yours, plus my base case assumption. You would have received here around 11, 11.5 in terms of an internal rate of return, right? Now, because we had, for instance, I think that's one case, a massive bubble in housing that you saw on the other chart that sent their earnings up, the market paid up, short-term bias, right? If you had bought it, and again, all the future cash flows here had happened, plus my base case forecast, which is very close to an average, you would have received, let's say, 7%. Now, it's not terrible. It's a company, it's a real company, one of the major building materials companies in the US. They do wallboard, they have cement, they have aggregates, they have a bunch of stuff. It's a real company, it's a great company. So they do have real cash flows. Even if you overpay for something, you still have a positive return. But if you look at the opportunities that you have, and even here, it's just because the calculation here is done only at the end of the year, but at these points, those 2 points here, for instance, your return, if you had bought them, again, if you were Warren Buffett, you bought the whole company and had to hold this forever, you'd get, let's say, 16% returns. Now later, do a compounded calculations of what 6% versus 16% does in 10 years, and you're going to see how extreme those things are. Right? If you invest your money at 6%, you'll be okay. If you invest at 16%, you're going to be really rich. Right? The average return of pension plans, endowments, in massive hedge funds, it's 5% per year. Right? So what the market, which shows you the inconsistency sometimes of the short-term bias of the market. It was giving you, even here, after the recession was over, the chance to get around, let's say, 16, 17% returns. Okay? Again, on an annualized basis. Okay? So, why I showed you this? Because I wanted to just quickly show the two conditions here. You saw the short-term bias by the earnings. Earnings move, share prices move. And this is clearly, in the case of Eagle Materials, it's a very cyclical company. Right? I mean, the market should know better, right? But it doesn't. But there is a reversion to the mean. You saw the IRR of the company going from very high numbers to very low numbers. Okay, so that is, let's say, let's see if I can. Okay, there we go. Let me close this. And now let me go to what I said, which is the real template. Now, I work with 3, 4K monitors in front of me. I get a little tent by the light, right? This is not the same resolution. So let's see how I can show this to you. And there is a lot of information here. I'm going to zoom in and out of these sections of those templates. So you can see the corporate finance aspect, you can see the fundamentals aspect of evaluation, right? And then try to make a link on this. So this is my template for one company, and I have 60 of those. There is some data, summaries, inputs, model. The model is here. Debt and tax analysis, shares, if there's guidance, some my notes, I follow who are the managers. I have some custom analysis. Oh, the estimates, you saw that. right? There we go. The chart is here. It's something that I look at, all the time to say, what happened? What led to this? So let's make an exercise here. So if you were 95, and for some reason you are like the best analyst, you just have this crystal ball. So what would you have to tell your boss? Why your earnings simulations would be this massive zigzag? Look what you would have to tell that person and convince him or her that your analysis was correct. You'd have to say, look, earnings will go up because we are going to have, the economy will be booming in the US. People will be building a lot of stuff. They will be selling all board and making money. However, there will be a recession. And at the same time, to add insult to injury, natural gas prices will go from $2 for MBTU to $12 and crush their earnings. And when everyone will be losing, hope for this company, they will embark in this massive earnings growth because of the biggest housing bubble in US history. And when it gets to 2005, 6 more or less, that bubble will burst. And it will burst in a way that you'll have multiple years of awful earnings because housing will stay there close to 500,000 starts versus 1.5 million starts, which is the norm in the US, for years. But yet, even with a very meager recovery, this company, together with USG and a few others, will coordinate their prices, even with 50% overcapacity. They will be sued by that. They will lose that, but they will still be able to keep their pricing. And in all this, there will be this mini bubble here in expectations from a thing called frac sand that you don't even know that exists here yet. And that frac sand will go from $20 to $180. And analysts will project this as if this company would make $1 gazillion selling that, but they will not. Can you imagine trying to do this in 95? It's like, are you nuts? Right? But that's what happened. That's what really happened with this company. It's a saga. There's a lot of story in 20 years, and the numbers will always show you. Now, what I'm going to try to do here is, where can I use corporate finance, my valuation, to see those numbers? You can't forecast that in 20 years, all those events, right? I mean, it's not something that you can do. But would you be able to know that those earnings were extremely high in historical terms and at least not buy it here? Would you be able to know that those earnings were unsustainably low and something would happen, either capacity would be closed, prices would be manipulated or agreed upon, something would happen, right? Because no one was making money here, so you would be inclined to buy it. And would you be able to see that those earnings expectations here were, the chances of this happening was very, very small because of the nature of this new business, right? And my answer is yes, you can do that. And that's corporate finance. It's like, okay, so let's see how you go and try to break those numbers in something that's more manageable. That's real analysis. Okay, so what I try to do to value a company, and by the way, I might want to show you, let me see. Yeah, it's a lot of numbers, right? But those here, again, that was in a presentation. There you go. What we're seeing here is the same chart again. Now, those dots are my actual valuations change over the years. The information comes and goes. I get confused. It's not easy. I'm trying to find what is the fair value over time and take my positions based on this. So this is actually my last position in this name, which is a short. Right? So I've been long this name, I've been short, I'm short again. Right? Now, and again, that's the reversion to the mean and with the earnings that we saw before. Okay. Now, my job is to literally do those three little lines that you see here. Those are the plots of my low case, base case, and great case scenarios. First, you're going to see that I have here 10 years of forecasting. It looks very small in this chart, but it's 10 years. Why I do 10 years? You saw how much volatility this company has. So now, in this part now of this session, I'm going to give you some tips. They're modeling tips for those of you that will work with you. Now it's time to take some notes. One of them is, do not do a 3-year model. Who can forecast or simulate a complete cycle in 3 years? Don't do that, right? So I have 10 years because I will try to simulate a new peak in earnings, a recession, a new peak, and then a normalization. And from this point here, I will jump into my perpetuity, which you see is not a small formula. I'm actually extending this model for another 100 years. We have computer power for that now, right? Now, but my job is to say, what are the scenarios where those different paths of earnings happen? And I get those paths discounted by a cost of equity, because I do a discounted dividend model. I'm going to show you. And that's where my fair values come from. And those are the fair values, the great case, base case, low case that I use to short, buy, and close my positions. Okay, now, so let's go then. So if this is what I want to do, I want to have those scenarios. And this is my base case here. So where do I do that? Where this comes from? And what you're going to see is something that really looks like one of the models that you guys are doing. You are going to see income statements here on the left, right? Income statement. You're going to see a balance sheet. You're going to see cash flow statements. So this is another tip for modeling. Always do a complete model. I have seen so many models without a cash flow analysis, right? Or a balance sheet where so the person doing it is not even aware that the implied return on that capital is 300%, and the historical one for the company or for the industry is 15%, right? So if you don't have all the model complete, you can't really see a lot of stuff. So it needs to be complete. Now you're also seeing that's very clean. I'm going to show you where I do my mess. So your core model, your core corporate finance model, is just to feed a few key lines from somewhere else, from another part of your template. And that's where you're going to do calculations that, again, you are doing. And let me show you one of those, which is here, the present value of dividends, right? Again, you see there, I'm just multiplying by 1 per share dividend that I'm forecasting for this company in different scenarios, right? Now, this is, again, this after all, is a corporate finance class, so let's go in the concepts here. When most times you do a discounted cash flow model, so cash flow to the equity holder and the debt holder. What I learned over the years is that when companies go through crisis, be that an industry crisis or a recession, the cost of their debt changed a lot. And I was caught by surprise in some of those, on those situations. And I decided over, a certain moment to say, like, you know what? It's better that I do a discounted dividend model. But doing a dividend model implied on me having to build that spreadsheet here, which what it does, I will model the whole debt structure of the company. I will simulate what's going to happen with each one of their tranches. Because at the end of the day, what's going to really happen, look what happened with this company when they were in the crisis. Look at their coverage, if you will. Their debt was much more expensive. And as you forecast, the company getting into a cycle and leaving something like, the peak of a crisis, their debt cost went from 7-8%, and it's now getting close to 4%. So what I wanted to do is to capture that dynamic. And if you go directly to the cash flow and you stop before modeling the debt side, you are going to miss that part. Okay? So then this is the reason why I decided to do here a discounted dividend model, which you discount by your cost of equity. It's not your weighted average cost of capital anymore. Right? So again, this is full corporate finance theory being applied. Another thing that I want to show you, again, there's a series of calculations here. Again, zoom in on the information here, just so you can see the numbers that I when I was talking about the IRR. The IRR is this. This is the on that date, the end of a fiscal year or start of one. That's how much the market was willing to was pricing that company as of like $3.2 billion. So let's suppose you're Warren Buffett, you bought this without any premium, and you bought the whole company. You would get, and those were real cash flows. And then you go to your forecast. But if you keep doing this back to 20 years, what you have here is a lot of and of course you keep that's 10 years, and then you have another thing. It's just that it's not short. So you will go back and you have 20 years of history of cash flows, and then you get into a forecast. And those were the internal rate of returns that we were discussing. So those are the numbers that you saw in that chart. Now, but let's go up here and say, okay, so you showed us then that there is a link with fundamentals or with corporate finance. But then where are those numbers coming from? So how do you forecast those earnings? And then that's when the whole history of the company, the fundamentals it's important to then go to the fundamental side of the equation, which is, in my case, is here on this inputs page. Again, there's a lot of information here. I will zoom in and out. Maybe, let me see if I can hide a piece of this thing here so we can see. I hide this. Yeah, okay. What you're going to see here is for different assumptions. Look at here, fresh sand production, different levels for different scenarios. What will eventually drive my earnings that you saw are different assumptions, all organized in one place, so it's easy for me to compare one scenario versus the other. But the real work is down here, right? So again, I will zoom in a few areas here so you can see where the fundamentals make sense. So let's come here and see, what will drive the sales, let's say, of wallboard of this company. It's their market share and the production in the industry, right? Not that complex, right? Now, you're going to have your assumptions on market shares going forward, but more interestingly, you're going to have your opinion on how much wallboard will be bought and sold in the US. But I'm not going to open multiple templates here, otherwise my computer might complain, but if you look at my note here on this, it says that it's coming from my USG model. USG is the biggest manufacturer of wallboard. There, I have an analysis showing that the correlation between wallboard sales and new home starts is 92%. So at that point you say, oh, so now I understand that. I need to have a view on the housing sector of the US, and you take a step back, and you might want to do something, let's hope this is not going to, like this. This massive zigzag is the new home starts in the US, right, since 59, which is crazy. Because if you think this is the biggest asset that most families will ever have, is their house. And what in blue are the month by month figure, and what you have here is a 1 year moving average, so you can at least see some patterns here. And clearly you can see all sorts of shocks and recessions impacting the housing market, right? So the oil shocks, the savings and loan crisis, like 1/3 of the savings associations in the US went bankrupt. And here is the bubble that we had until 06, 07, and then this massive collapse, and we are here now, right? So before then, you can have a chance of guessing right the volume of wallboard that will be sold by the industry, and then the market share of a company like Eco Materials. You have to step back and do your industry study, right? And that is, you know, and to calibrate the amount of houses that I will assume in perpetuity for the US, I have to go one step even further back, and those blue lines here are the expected new household formations in the US, right? And you would assume that people are building houses because they want to live on them, or someone will live on them, they will rent. So this is the country creating an excess supply, and then we are building, for so many years, the new home start was so low that we started to have to create a deficit of houses in the US, and that's where we are today. All right, so imagine this, all this go directly to new home starts that has a 92% correlation of wallboard utilization in the US, and that will drive a big chunk of the earnings from Eco Materials. Now, on top of this, I was talking about price manipulation. And here is by collecting data that some of those companies make available. In this case, I'm talking about this little line here, which is the price of wallboard per 1,000 square feet, right? Now, what I'm plotting here in this analysis is the company capacity utilization, which is very similar to the industry, and price per 1,000 square feet. And when capacity utilization was very high at the last bubble, prices were, of course, high. But then, capacity utilization came to much lower levels because of the housing crisis, the collapse in the new home starts, and the price collapsed. But then, here is what happened with price without not really much change in capacity utilization. Right, so let's go then, might be worth trying to open another file here, because it will, it's the analysis there on USG. You're going to see that. It's better to see. So let me show you one thing here first. I told you that the correlation between new home starts and wallboard production was very high, and that's what you see here. It's extremely high. You plot those numbers and you know that's a fact. But here is when you start to look into the story of the company or the industry. So let me explain what those lines are. That line here is the volume sales of wallboard for USG. That's the biggest producer in the US, 25%, 27% of market share. And of course the crisis came and it collapsed. Now imagine that a company that had this capacity, that's an index, was producing that much. Right? And this here on those dots, that's the industry volume, also collapsed. So at this point here, everyone in the industry had massive oversupply, right? And at that point, look what happened to the blue line. This is the quarterly price for wallboard at USG. How come this moved that way? And again, moved like this. Now, there was not really a big change in volume, right? I mean, this is price coordination. Were they really talking over the phone? Maybe not, right? But clearly the CEOs were signaling to each other that they want to collaborate in pricing. And that again is to tell you it's not only then about numbers, just putting numbers there and forgetting about the dynamic of the company. Earnings just rebound starting here in 2011, 12, and 13 because there were price coordination in the industry. Now, they never admitted being guilty, but both USG and Eagle Materials, USG paid how much is that? $48 million, and Eagle Materials paid another $39 million in fines for pricing coordination, right? So, and what it does, if we go back, let's go to Eagle Materials, let's go to another section of this template, and show you that little chart here. This is the operating profit per 1,000 square feet, right? So what you can see is what you saw on their earnings, very similar pattern, right? So the early 90s, the boom, then it collapses because of the prices of wallboard. Then this is the housing boom, and then it collapses again and forms this plateau. At this point, no one in the industry was making money. What they did, they coordinated prices and were able to hold that price and raise their profitability at very high levels. That's where we are today, right? So again, if you want to model, let's take a step back. If you want to model the earnings of Eagle Materials, or have a chance of modeling that, and making sure that you're making the right investments, or imagine that you're doing an M&A, a venture capital, you name it. That's the type of information that you need to have, right? So, and the reason why I will build that template and spend hours and hours through this is because this is the tool that allows me to see that stuff, right? So that's the idea. The idea is to be able to disaggregate the company completely, understand the industry, and go segment by segment. Now, that gypsum segment, it's very numbers driven, right? I mean, how many home starts, correlations, and pricing. Now let's see another segment. Remember that when we were here again. So that what you saw on that chart is very correlated to this, but how about these earnings estimates? That there was a bias to the estimates, but they never happened. So that is a completely different fundamental approach. It's much less numbers driven, and it's much more, it's almost like an investigation that you're doing. So let me let me tell you what happened over those couple of years, in those 2 years. So management came, and by the way, management, I follow them. Look at that. They have pictures who they are, I give them a certain grade. When they change CEOs, CFOs, people love this, but I never found a correlation of this page with anything. They just come and go. It's the page that my investors, that's the page that they like the most. But there is no correlation. It's the industry, it's not management. All those guys are educated enough that they know what they're doing. Their forecast, though, is awful, right? Let's come back here. I hope that they're not going to see this, but so let's talk about this little line here called oil and gas propanes. You see here, those are the 3 years that we have data for that segment. And as you can, that's operating profit, and it's 0 or negative. But I told you that analysts were forecasting huge impacts on earnings. They were forecasting for those lines, for this year, and this year, $200 or $300 million, right? And then again, negative numbers, and it's probably going to be close to 0, right? So what happened? So what happened is, let's go now to the story of that one segment. So management, and this is my notes page. Everything that I find interesting about the company, I'll go there and just copy and paste in one place, organize so I can go back and look and read. So when they, I don't know if everyone here is familiar with fracking. Fracking is you're drilling for oil, and it looks like oil now is on those structures, they are like sponges. There's oil and gas there, you drill, you put a charge there, they explode, they crack, or they fracture those rocks, therefore the name of fracking. oil and gas starts to flow. However, if you just leave them there, they will collapse on itself and then the flow stops. So what you do, you inject sand. But that sand needs to be a somewhat roundish sand. Because if they are very irregular, they will block things too, the flow too. If imagine spheres being put together, there is space there, right? So gas and liquid can flow through that. That's exactly what fracking is, right? Now, so then what they realized is that around here, that region of the US, there was this very special type of sand which was very round and very, very efficient for that purpose. So what this company did, they said, hey, why we don't go and get the sand, mine it, dry it, barge it down to here. And a barge is this thing here. It's literally, you know, made of like basic metal, a motor at the back, and you can throw a lot of sand there and it's still gonna float, and you barge this thing down. Now, they also published pictures of their own sand, their mines. And here's when I started to see like there was something off on this story of those $200 or $300 million. Now first, again, there was no earnings, no historical figures for me to look at, right? There's no pure play sand producer that I could compare to. And that's when your manager or MBA type of hat has to be used. Like, let me analyze this from an microeconomics perspective. What should happen in this type of business? The first thing that I noticed, like, this is like an open pit. I mean, what is unique about this asset? Right? I mean, well, maybe they are very rare, and they only exist in very specific little pockets. They were lucky to find them, and they're going to sell this for a lot of money. Could be, right? But it looks very simple, and it is very simple. Anyone can do that. On top of this, even if your sand mine here is closer to a rail station, because it's very heavy, you probably have to use rails to transport this the more you can. There is this long way here down that you're going to use barges. And why they had to send this here, by the way, there was this awesome interactive thing on the Wall Street Journal, I'm not sure if it's still active, that you could go and just select a date, it would show you all the fracking sites that were active, right? So what you did is saying, so they're getting sand from here and barging down to serve those guys. It's like, okay, so I understand the purpose. So there's a lot of activity there. There's not sand, or at least not round sand down there. I'm going to barge that down. I'm going to mine and send it down. Now, however, and management kept saying, oh, those are unique assets. Now, through some research, I went to Google. It's like, there's a lot of space around those mines. I mean, is this really unique? Until, by pure research, I found this website here, conservationvoters.org. And what those guys were doing is actually registering every single sand mine in that region that they thought had an impact in the environment. So when I went through this website, there were like many sand mines out there. So then I started to, like, oh, so then my case is built. It's not a unique asset. There are many of them down there. You have this massive cost to transport from here to here that will affect anybody, so you're not going to have a cost advantage. So, and this is a commodity. People are going to literally look into your sand and say, yeah, that's similar sand that that guy is selling me. Then you're not going to make $200 or $300 million in a $200 or $300 million investment every year, right? And that's exactly what happened, right? In other words, so if you look, and of course, to add insult to injury, oil prices collapsed, the number of drills in action collapsed too, people were using much less sand, right? And that's why, if you look at what happens with the sales, let's go to that one segment. It's a lot of information, right? It's here. So sales, that it was nothing, went to $80 million, 58, 35, it's rebounding. But the level of profitability, it's now consistent with a commodity, not much. Like if anyone can produce that, there are many mines available. There are a lot of barges available now. At the moment, there were backlogs for barges. What do you think happened? They produce a lot of barges. There is an oversupply of barges now. They don't make any money. Right? So yeah, so now let's get another step back. So what did I show you here? I showed you one segment, the wallboard segment. I showed you another segment affecting only expectations because there was no earnings here. At the end, all this affected prices in the short run, which gave you the opportunity, for instance, to start a short around here and close it eventually. But all this, the only reason why I can go and do what I believe a meaningful forecast in future earnings that will drive the future price of this company is through a lot of fundamental analysis. It's all filtered through, if you will, your classic corporate finance model. Right? So that's it. I mean, so why do I use those models? Why do I use corporate finance that you're learning? And literally my version 1 started at Columbia. And then my models now, this is still version 10, I'm on version 12. Every time that I develop something new or something I should have seen and I didn't see, I go and change it and update it and increment it, right? So this is the, that would be the summary of, so let's go back to the, if you will, to the presentation and see if we did, what else? Yeah, I should have left this open then. There you go. Okay. Play. So there you go. I told you, let's go here and see what we came here to do, is to establish the link between corporate finance and real-life application. That is the model that you saw here. And it's a real corporate finance model. Right? So the concepts are all there. P&L, balance sheet, cash flow analysis, it's all there. Discounted cash flows, or in my case, discounted dividends. I hope some of you had some ideas on what is a good fundamental analysis to support your evaluations. If you have sales, it's always your market share versus volume. Right? So then, what is driving those volumes? And sometimes learn to build your support for drivers. That's how you're going to get convinced that you can't say anything. This company's market share is they're not going to gain 8% market share in 2 years. Right? Or volumes will not spike out of the blue. They will follow new home starts, that they have a limit on how much they can increase. I hope that I was able to explain briefly why fundamentals work. So that's why I spent all my time, or most of my time, doing this, because I want to be better than the average investor out there in forecasting those earnings, because they will drive share price, right? And I did this by showing that model and some specific analysis. I know it's very boring, but I hope it could serve for some of you as an inspiration for, if I want to do this, if I want to improve my modeling skills, that is the type of analysis that you have. You have to get assumption by assumption and check if you can find a support for that. And many times I started to work in a company, and 2 months into that effort, I said, I can't model that company. I see the inputs, I see the numbers, but I can't find the drivers. And that's when I say, now I can make that model say whatever. just because I couldn't put my hands around the drivers, the fundamentals, the story of frac sand. Right? So I get my clients' name, the money, and put on positions that I was, in the case of Eagle Materials, not in this short, but the last one, it was all based on everybody else being wrong about the prospects of their frac sand. Luckily, in this case, I was not luckily, I guess, but I was right, and the average participant was wrong, and that's why I made money in that position, right? So, and that's what I try to do. So that's why I spent all this time. But again, I came here to show you an application of what you're going through. It sounds very theoretical, but if you spend a lot of time working with this and developing your templates, you're going to see the use of that. I think that's my, we have time now, I hope, for some questions. And we have, yeah. So.
So how do you know where you are in the business cycle and then where the trough, I guess, estimate would be? So how do you know you're in the middle of it, on the upswing? I think you had a graph on there that showed it.
Yeah, so so two things on this. You never know exactly when things will turn. You just know, like, oh, this is really low. And what really low means? What you're going to see that CEOs, they wake up every day to make money, right? For their company, for their shareholders, for themselves. So what you will start to see in different industries, again, this doesn't work for every single industry. For startups, technology, finance, healthcare, forget it. That's not the tool, right? I mean, I have a hammer, I can drive some nails, I cannot do like small holes in a wall, right? I mean, I would need a different tool. But the way that you start to have some clues that, for instance, you are in a bottom is by observing operating profit on that segment. It's very rare, unless you have a massive SG&A deleverage, to see companies for too many years losing money, or in other words, to see your operating profit per ton or per square feet, whatever it is, to go to very negative numbers. When it's there, you know that everyone will shut down capacity, fire people, stay there 2 years, like that. That's bottom. Can it get worse? Oh, of course it can get worse. So the amplitude of that bottom, it's also very hard to know. And exactly when it will rebound, it's also very hard. I'll give you an example. To keep me honest, let me show you what's up there. I mean, this is to show you how boring my life is. So the first time, it's really, I have an investor, the guy runs like professionally with motorcycles. And I was trying to explain to him all the adrenaline that he has in 2 minutes of one race, I don't have in my whole career, right? I mean, it's boring. Now, so my it's not that funny, right? I guess. So it's sad. So the first template was done in 2007, right? And what I do, I freeze my own next 10 years of earnings. I say, oh, if I think I'm really good in forecasting earnings. And now, in this company, since 2007, that was hit by a tsunami. Right? This is as bad as it gets. Like the housing crisis in the US was surreal. And it's still surreal in the sense that we are not building 1.5 million houses yet. Right? 10 years after the crisis. Now, what happens, I can then see, which I do, I can show you, I call this my Hall of Shame chart, right? What this is, you see here, that path, it's me being wrong about when those earnings would rebound. I was directionally correct. Those were bottom earnings-ish. What I didn't know is that the crisis would be so severe that the whole financial market would collapse. We almost went to a depression. Right? There was that one weekend that Paulson walks in and give like billions of dollars in equity for each bank. If you haven't watched the, what's the name of the movie? Forget now. It's not a big, too big to fail, right? I mean, this thing is really fascinating, right? Because if that weekend had not happened, we would be in a depression. So the severity of the crisis was so intense that I don't have a crystal ball, right, for that, again, otherwise I would be the richest man on earth. But you see here me, with all those earnings, and here it's me getting wrong again, thinking like, this expansion has to end, and it doesn't, because it's a little slow, so I keep, pushing my peak 1 year after, another year ahead, and this, of course, but if you look at my valuations here, they are more or less, there are some variations here, but on average they are not deviating that much. But here you see also in the first one a big correction in value because the size of the bottom was so massive. So again, my point here is, if I show you though that chart for Coca-Cola, that's like a straight line, right? But Coca-Cola is priced on average with an implied return of 8%. This company is priced, companies in this industry, usually with 11.5. I actually like more this type of company than Coca-Cola. Coca-Cola has its role in my portfolio, which we're not discussing here. For instance, when things are really getting really bad, those are usually the last ones that will get cheap and get into my portfolio, and then you feel good that those companies are there. Yeah, so you are also using a green shirt, so I changed my colors. Yes.
I have a question about, in terms of revenue projection, because I feel like that's a very important part of the financial model. There are certain lines of revenue which utilize like projections on future commodity prices, and I'm just really curious what kind of method do you use to project those? Because in also some of the research on say airline or cruise line, you also have to predict say like oil price. But I think for individual researchers, it's very common approach is to use like the latest price as for future projection. But it's really hard to say what's the oil price going to be in 2020. But I see in your model is that the number actually jumps around every year. How do you project that?
So lesson number one: never try to do this for commodities. They're gonna kill you, right? Because the only thing that you can do. I don't think I have this version. Have you ever heard about the concept of cost curves? Where you literally plot. Did I bring this back? Probably not. That's so many models away. I don't have it plotted here. Okay, so I'm not going to go there. But you'd have to know globally, or if this commodity is global, let's call corn. Where is it being produced? What's the cash cost, just for FX ratios? And that's what's in the marginal player in that commodity will drive that price. Shoot me an email, I can send you a thing written in the 80s. That's even old for me. That works extremely well in understanding the dynamic of those cost curves, but they are so hard to build. And they are so hard to forecast. There are things that you can observe, but you can't forecast. The weather, right? I mean, or the weather in a year. We can forecast 5 days, right? So it's not because you have data and you can see a lot of stuff, it means you can forecast. Cost curves, they are forecastable, but they are so hard, it's so time consuming that I made a strategic decision not to touch those. So the companies that I follow are not the commodity producers. In this case, it is a commodity, but it's a building materials thing. It's not exactly your oil or corn or that stuff. That's different.
So cement will be easier to project, is that?
Yes, because it's super local.
Gotcha.
Right? Cement doesn't travel, and it will vary, but it will not get crazy.
Thank you so much.
So I have to be careful with, so now I'm not a green person.
How do you identify companies that you want to look at? How do you identify companies?
Now I have, my life's already boring enough, so I have 60 companies that I do this for each one of those, right? And the reason is, and now this is more portfolio management, which is not what we're discussing here, but I need a certain number of companies to be able to build my long short, long only, long aggressive portfolios, and 60 is enough, right? However, I also have my bench, because they just made an offer for USG, and I hate it, right? When they do this, it's one of those templates that I will lose that. And that bench is, then it's me reading the newspapers and saying, oh, look at this industry here. Like, it looks like it has some inputs that will make earnings confusing. So I will be able, so the market will get confused, but there is a reversion to the mean on those inputs. Maybe I can model. So I have my spreadsheet where I have that, stored. I will keep it there. When I need it, I go there, get one of those, and develop it. But I do this like 2 or 3 times a year.
I have 2 questions. So the first one is, how do you discipline yourself so you don't get too excited or too depressed in the valuation because you still have to put money in that? So how do you control your emotions? You seem a pretty rational type of guy, but still there's emotions there. And second is, why did you open a company in the US and not in Brazil?
Great questions. So first one, I have a friend that when he sends me email, he calls me friendly finance robot, right? Yes. So I am very stable in that part, but that's actually a very great question. Not corporate finance, sorry professors. That's totally portfolio management. So the way I build my portfolio is through a set of rules. In other words, my longs will be 5% of the AUM. My shorts can only be 3%. My net long can only be 60%. Net short, 20% growth. All sorts of limits. And I will buy them when they cross my low case scenario for 10 days. Why 10 days? To give me time to cool off, do the analysis, right? But still be urgent enough. And then I'll buy it. Same thing for the short. It has to be 10 days above my great case scenario, and I'll short it. Now, those templates are so old that even if the emotions want to trick me, I will probably do some of that. But I have limits, right? Because again, I have so much information. I will not go one day, wake up and say, oh yeah, the stock fell 30%. I'm afraid as hell, I was expecting this, I modeled this, I adjusted that, like, yeah, it's still very cheap, I should buy, I just go and buy. Give you an example. I just bought a company called Tempur-Pedic. They do mattresses. And they bought one of the big S's, Sealy, the Sealy Certain Simons. And the story with the CEO, I have never seen this. The guy issues options and restricted stocks. I have a section in my template for options, restricted stocks. Many times there is nothing there. You just input the numbers, dig to the 10Ks, and there's nothing. Until one day you see a new CEO that comes in and issues options, and in restricted stock that are 50% of the operating profit of the company for 2 years of work. It's like, oof, right? So and then he goes and fights with his biggest supplier or reseller, Mattress Firm. They fought with that company. They lose that account, lose 21% of their sales. Of course, earnings go down, right? And then what the board does again? Well, since you're not going to hit your objectives anymore because you messed up so much, let me issue again new options with lower prices. Again, 50% of operating profit. This is there. It's public. It's in the 10K. No one cares. But the price got to a level that is so cheap. It's below my low case scenario, and I bought it. Am I afraid of buying this company in an economic cycle peak with this guy as a CEO? Of course. But it's a chess game. If there is a recession, mattresses are affected, but not that badly. But they will be. Earnings might, will go even further down, but the value is there. I'm buying that company with an implied internal rate of return of 16%. If I keep doing this, even if it takes me 5 years to get that money back or get out of the position, it's fine. That will be a good investment. So that's my point is, I do my valuations, I keep updating them, but to build my portfolio, it's rules, not a person, ever. Second question was, and I forgot.
Why did you open a company in the US, not in Brazil?
Oh, yeah. Are you Brazilian?
Yeah.
Yeah, sure. Yeah, me too. I have a small accent. I'm kidding. I came here in '99. I don't know if you guys are familiar with like the types of intelligence from Howard Gardner. Awesome book. The guy's like 7 types of intelligence. One of them is linguistic. Clearly, I don't have it, right? No, seriously. My kids now, they make fun of me all the time. But so all this to say, I'm also Brazilian, and they ask me this all the time. The problem is there is no data for at least 60 companies in Brazil. It's hard to find comparables because I like to do my evaluations in a couple of companies, USG and Eagle Materials. Now, Old Dominion, trucking company, and then I'll do JB Hunt as a peer. Right? So I'll do pairs or maybe 3 companies because I learn a lot. But so in Brazil you don't have that. And the worst part, which will make my long short portfolio impossible, is in Brazil to short is extremely expensive and illiquid. So it's here. So I need a closed system. Let's call the US a closed system where there's a lot of data, there's a lot of companies for me to choose from, and it's extremely liquid, therefore cheap, not only to trade, but to short. Make sense? You cannot do this in Brazil.
I have 2 questions as well. The first is, what are your thoughts on value investing? And the second is, do you mind emailing us version 9 of this Excel sheet?
Yeah.
Version 12.
Yeah. No, actually, I would be a disservice sharing the template. Is that right?
No. But your thoughts on value investing?
Yeah. Value investing, that's interesting because a lot of people initially I used to describe me, although if you Google, you're going to see that I'm going to present in a conference in Italy. It's called Value Investing Seminar. Value investing, there's a lot of fundamentals there. But what I learned over the years, and I had a lot of value investing classes here at Columbia, there's a tendency for people to be storytellers, that one, right? So where they will tell the story of a company, not really quantify that way that I'm doing here. And they will place their bets on that company. As if they were describing one of my scenarios as a certainty. Over the years, I said, like, let me make sure that I do not call myself too much as a value investor. I am a fundamentals-focused investor. I saw that earnings, there are many things that maybe there are other things that causes micro movements in shares that people can capture with speed trading, whatever, right? That's not what I'm doing. I'm just capturing those long waves of price movements that are following earnings, which is more or less what value investors try to do. And they will focus on the fundamentals too. In other words, they will not buy something just because they think someone will pay more for that thing in the future. They really believe that the cash flow is there. But careful with when you read a lot of books, the analysis is too simplistic. I couldn't see all those, what is driving those earnings? And over the years, I realized like what you need to do is to focus in a select group of companies in industry that this can apply to, not every single industry, every single company. And keep going back to the same company, again, boring as hell, but it's much better in terms of increasing your chances of getting those earnings correctly. And for that, use a lot of literally corporate finance, like your basic tools.
Another question. Sorry, I'm asking again. My question is about as for the in the hedge fund structure, like a lot of analysts contribute research ideas, and I think portfolio managers, on the other hand, really think about a portfolio like allocation and like the portfolio theory. And you mentioned earlier how like the way how you determine weightings or allocations to your portfolio is really systematic. You follow a certain sense of rules. Just curious, like right now there's been a trend that people use quantitative or systematic algorithms to sort those ideas and allocate the portfolio. So the research part is still done by human analysts, but the PM's role can be like sort of replaced by like algos. What's your like thoughts on that trend?
The portfolio construction I have been replacing the PM for 12 years now. Yeah, you shouldn't have a human building portfolios. But, again, the human has to design the rules, right? I mean, if you keep getting massive quantities of data, and you're gonna find some sort of combinations that will give you a lot of money looking backwards. And I provide 3 types of portfolios to my investors: long short, a long only, and a long aggressive. What do you think happened in the last, let's say, 2 or 3 years with the long aggressive? It killed the market. But what do you think is going to happen when the market goes down 40%? Which is what I need to buy half of my names. I need a correction of 40% from where we are today. I mean, that one will lose 60%, right? So careful though, that when replacing the human, not having your computer do an excessive amount of feeding during backtest, because you're going to find portfolios that will be beautiful, and then they have absolutely no power to predict anything in the future, and they'll blow up.
Yeah, just real quick, for your long aggressive then, how often do you, I guess, reevaluate and reweight the portfolio? You said you need like a 40%. That may get crushed if the market goes down. So how often do you reevaluate and reweight?
So the valuation is at turtle speed, right? It's me opening each one of those. I still have 21 10Ks to incorporate, right? And you see that 10K season take me 2 months to plug all that stuff in my nest. So there's no solution for that. I cannot hire cheap help, because if I hire a young analyst to touch those templates, can you imagine what happens with them? Total destruction. Actually, I trained a couple of guys. It was very funny what happened at the beginning. I gave one template to the guy. I said, hey, you need to, let's do like a simple exercise. Get one that's on version 8 and put this on version 9. Right? So version 9, it was more advanced, had a bunch of new features there. And then literally a month and a half later, the guy comes back. It's like, look, I'm going to give you time. If you need my help, you ask me. And he would ask very specific questions, and we had discussions. A month and a half later, he came back and said, hey, I'm done. When I look at them, I was like, oh, but this is the version 8. Like, no, I got the version 9, and I made changes, and now it looks like the other one. It's like, no, that's not what I asked you to do. But you just destroyed all the new stuff that I put in the old model, right? Which is because it is very complex. So again, the valuation is extremely complex. A very smart person will take a few months to be able to do that. However, so let's suppose though that valuations don't move that fast anyways, unless there is an event. So, but let's suppose that there is a market event, right? The market moves 15-20% down. Again, but this is now portfolio construction. I monitor those things every day. So I have my ideal portfolio and my actual one. I get one specific one and I measure how much I'm deviating from ideal to actual. When positions deviate, let's say 3, 4, 5% of their ideal size, and then I have then that's now literally trading. I built my spreadsheets and my VBA programming, whatever, to replicate what I have in my core portfolio or my model portfolio to as many accounts as I want. I'm not running a hedge fund anymore. It is old school. It is not necessary anymore. All that structure, it's not necessary. You can do this through managed accounts. But then you have to program your rebalancing of each one of those, upload on interactive brokers, and then it trades through VWAP, charging me 35% of a cent per share, right? And that's when the adjustment is done. Now, it will be the wrong adjustment looking backwards if at the same time the market correction is causing the value of my companies because of a strong recession, whatever it is, to change, and I didn't see that. But all my models now simulate a recession in the next 2 years. When we get to economic cycle, peak, I start to simulate a recession. And the reason is, when it comes, in retrospective, my fair values will not change that much. So then when I look back at the trades that I did, to adjust now, between the actual portfolio and the ideal portfolio, they will look more or less correct. Right?
Do you talk with the management of the companies that you follow?
I do, but you know that where's the best source of information is the investors' relation. The management, because of the Reg FT, right, is the regulation that forces a company to share meaningful information at the same time to everybody. So for instance, through the wiring services, you see companies publishing the presentation that they're going to use at a Goldman Sachs conference. They file an 8K. Why they do that? Because someone that goes to the conference gets a position and that's profitable, and they can share with everybody, then the management is in trouble. So then what happens is management, they have their script, and that's the only thing that they will tell you. They will tell you all those bullet points that are in the presentation. There's really not anything new there. The investor's relation, though, is that guy that he will not give you any information that's not, again, in one of those public documents. But he's the guy that will be available to clarify what is driving your SG&A here. Is there a presentation where you disclose some information that will help me model this better? What are the drivers? That type of discussion, that's the investor relations. And they are super accessible. They're really nice.
You mentioned that management told you that those mines up in, it looks like Wisconsin or something, were unique, and then you actually Google searched and found that they're far from unique. Doesn't that give you pause to think like maybe this company, the fundamentals are great or whatever, but the leadership has no clue what's going on with one of the key materials to part of the business?
You see, if I were to show, you're right, but it's every company, basically, right? No, seriously, I mean, I'll give you an example. That for me was, I can't believe that this guy is saying that. Is the CEO of Deere, the tractor manufacturing company. There was this massive bubble of agricultural commodities caused by the ethanol mandate in the US. The US from 2005 to 2012 had to double the area planted in corn to satisfy the ethanol mandate. That, of course, sent shockwaves globally in the commodities industry. Brazil was at the peak of that bubble. Right? Every Brazilian thought that by 2011-12, Brazil was really the best place to invest, but that was the peak of the ethanol bubble, which was also coincident with the iron ore bubble caused by China, totally independent. But that CEO, even just after the peak, that data was available, you could track how much ethanol was being produced, and you could make a very good guess that earnings would have to go down, right? Or they would stop to grow, whatever it is. He had a public presentation that was literally an extrapolation of the last 7-8 years, exactly during the bubble formation years because of the ethanol mandate, and saying that's how my sales will grow in the future. He was forecasting, let's say, 4 years ago, sales today of more than $50 billion is going to be 35. And he makes $15 million a year. It's unbelievable. Look, the compensation of CEO, CFO is bizarre. There are some of the plans, because GAAP, if you put some conditions on the options and restricted stocks, GAAP allows you to register a very small number. That's what's going to hit your SG&A or cost of goods sold, right? And which is already an improvement from the late 90s where they would not even report those. But because of this, you're going to find from time to time companies giving options and restricted stocks with some sort of conditions, let's say a certain level of EBITDA, which are massive. No one sees that. Look, there's a lot of information out there. No one is listening. It's out there, but it's shocking. But to your point, I think they are average. I think the average CEO, CFO, they think that their work is to always praise the company, always say that what they're doing is awesome. And it's one example after the other that's not the case. Yeah, I think that should be the last one, I guess.
So a lot of us who are like in undergrad, and I'm trying to figure out, so you said you were a portfolio manager for a while. I'm trying to figure out what's the best way then to become a portfolio manager in the long run. Is it best to start off at like a buy-side shop at a
Buy side or sell side, and you have to be an awesome analyst first. The answer is not on portfolio construction. There's a lot of track records are basically statistically insignificant. Doesn't matter, like, literally there's so much volatility in earnings, in share prices, in markets, that you need 200 years of history to say, this guy, that was not luck. So the learning or the knowledge is on the fundamental analysis. If you can forecast the behavior of the earnings of companies, then building portfolios, it's much more an exercise in risk control. And if you lock yourself in a room and probably a month later you're going to come out with 2 or 3 portfolio constructions that are really good and they will work on an automated manner, answering your question, right? So if it's automated and if it has some rules. So focus on learning to do fundamental analysis. Portfolio management is only like 15 years from now, 20. Okay, it's almost 7:15.
By the way, you can also send an email to Ben, and he's really happy to talk to Columbia graduates. So thanks again for coming here, and we really learned a lot from this huge table. And for sure, we're gonna not test you this complexity, but testing you like version 0. And hopefully, we can learn from this and develop your version 10 in the future. Thank you so much.
Yeah, my email. So that should be. Thank you for inviting me. Always available to do more things.
Yeah.
I'll wait for you.
Pretty simple.
Oh, you're gonna?
Yeah.
Oh, boy, they like your life is so much.
No. But
I don't know, I want to go, but it's so far.
Thanks for having me.
Oh, of course. I'll send you soon.
Yeah.
Okay, cool.
Yeah, very good, very interesting.
Okay.
Sorry.
Alright, I'll look for next.
So yeah, I'm
Sure.
Is everyone leaving from
You're
here?
welcome.
that much.
Everyone like from the Z is like left with this.
Yeah, we just
It's better to start off on the sell side. So that's on the job description says measuring
You've got the slides up. Yeah, that's portfolio. That's not.
Yeah.
Thank you.
So just a general question, really, just usually idea, great idea. So I think because you're focusing on one industry. Are you focusing on one industry?
No.
Because I said, I mean, we were talking about this company and here, I assume.
Are you still teaching at NYU as well?
Yes.
No, I do industrials, I do